30 minutes of presentation on what I see as future of ESG. I share a bit of insights, also how we look at developments, and I've seen 2/3 of you partially integrate ESG, so you may take away a few ideas here and there, and I look forward to have a lively discussion after my presentation. Now let's see whether that works. Here we go. I have two heads. I'm the global head of ESG, so my full-day job is integrating ESG across all of our assets. So we're an active asset managers, equities, credit, sovereign bonds, multi-asset, and alternatives. So that is part of my, that's my daily job, really. And then currently advising the EU Commission on minimum requirements for climate benchmarks, ESG disclosure on benchmarks, green bond standards, disclosure on climate by corporates, and the famous sustainability taxonomy since July last year. All the topics will pop up throughout the presentation. There will be other presentations later, so I keep it a bit shorter on regulation, for example. I will also not dwell about climate neutral assets too much because there's going to be Bruce Dickinson who's working on EV planes. The Germans must have misunderstood something when they built the first carbon neutral airport in Berlin, so I think he's going to do it better. Here in my presentation I have three parts. So I first look at ESG, and if it's a stock, I would call it the fundamentals are really fully intact and it's growing. It will not go away, and if anything, it is about to get full mainstream. The essence and the core of my presentation will be on the investing side. So I will talk about ESG and alpha, what it means beyond the buzzword, concretely on risk management. I will focus a bit more on that part, but also in the last part, on the outlook, I will look into what still needs to be figured out in ESG. And I've been doing it since over 10 years, and I can say everything. I've been amazed about how much attention and mainstream it has gathered, but still it takes a few tools to really accomplish the puzzle here. Drivers of ESG. In essence, it's three drivers. The first of all is the client demand. So typically we have two sides of clients, the so-called long duration liability matching investors. So typically the pension funds, but also the insurance companies, like my parent company, Allianz SE, the insurance company, just announced last week at the AGM that by 2050 all their assets they are investing, that's 630 billion of euros, are supposed to be climate neutral. They have a pretty strong ESG integration program, which we also manage with them. We have on the well, I don't want to call it retail, on the retail side, an ever-rising demand by so-called ESG-affine investors. So a lot of the younger generation changing their way they look at funds investments. So they want to understand what's happening with the money invested in funds. And the same goes for high net worths, family offices, and endowments. So I come back later a bit about the demand side, but it's truly accelerating, and also the whole ESG mainstreaming is fired by regulation. The 10 points EU Sustainable Action Plan is still in the process in large pieces, but it has already created a huge effect, an announcement effect. So what I can see from daily business, clients approach us and want to understand how they will comply with ESG regulations coming towards them, like pension funds, but also fund distributors and benchmark providers, by the way. We have not only the EU Action Plan, in the UK we have the FCA and PRA working especially on climate risk and how that can be integrated. And it's a global topic, really. So interestingly, China, for example, has a green finance regulation, and on a global scale, and just a few weeks we had a bigger conference in Brussels about globalizing all the regulation. Interesting coalitions are in talks, like China and Europe, for example, concretely having access for Chinese issuers of green bonds in the European capital market and vice versa. So that's being discussed because a lot of the ESG topics are global in nature. The third topic, obviously, is how, from an investment perspective, why is ESG interesting? So the ESG alpha has two sides. Clearly, risk management, and I will get into more detail about that. So how does ESG enrich to better risk management in investing? And the second is really a bit of the opportunity side that often gets overlooked. It's about the impact opportunity and the whole transformation and investment opportunities going forward, where we aim to find returns that we don't find in many assets because of obvious reasons of low interest rate, monetary policy, and so forth. So those are three drivers that amplify the, if I want to call it, ESG stock and its value. I will go through a bit on some parts. So why is ESG getting more mainstream? Because there are simply more feedback mechanisms in the society. So you know about the Fridays for Futures demonstration that are not only happening in London, but also across Europe, and by the way, to an international degree as well. We also have a lot of debate, and we have a true, say, discussion now. When I was on the train from Brussels to London last night, I flipped through the FT. I've never seen so many ESG articles in the FT like yesterday. So the discussion continues, and it doesn't have to get as radical as Extinction Rebellion, but we are having a mainstream discussion in the meantime. We're getting more aware about a lot of the sustainability issues we are facing, and there's more measurement and also thinking in finance around it. Concretely, for example, what is the footprint on the Earth Overshoot Day? So currently we are overusing the biocapacity of our planet heavily, and what that means, we don't feel it right now in many parts, but likely going forward, so we have to deal with that. We recently had a survey of institutional investors on demand for ESG. And we got three key results out of that. So more than 2/3 of investors see ESG rising in grow in the next 3 years dramatically. So clearly there is also a reflection by asset owners and by investors. Since we're about this conference also about benchmarks, interestingly, a bit more than half say they would do more ESG if some of the benchmarks improved. And there's a lot of innovation in ESG, so I think this will resolve over time. It's one of the fastest growing index segments. Still, the overall share is, I think, below a percentage point of indices, but the growth rates are enormous on ESG indices. And some of it coming back how the regulation, for example, kicks in. In Europe, there will be mandatory disclosure on ESG in the benchmark statement and in the methodology in roughly likely 2.5 years, first for the so-called significant benchmarks and then for all benchmarks. There will be a mandatory disclosure on so-called Paris alignment of benchmarks, and there will be regulation minimum standards on climate benchmarks. So you can see also this kicks in and hopefully is also a good ground for innovation. So it shouldn't be a checkbox exercise, but an innovation exercise. And 2/3 say, or 71% of investors say that they will manage all their portfolios in an ESG conscious way. So the survey just had, where I think 2/3 said partially integrated, that dial will shift to fully integrated over time, very likely by in the next 10 years or so. So these are survey results that speak by itself. Now, client side, I mentioned that high net worths, for example, are ESG-affine investors, family office endowments, and the next generation. I think what's important is while that clientele wants to understand what's done with the money and want to do a real world change, so-called impact, so improvement on the environmental side or social side, I think what's important is that the performance of whatever financial product fund needs to be excellent. So the one needs to go with the other. There is no market for non-performing ESG funds. Also, what we see in the mainstreaming of ESG is that we typically also see in the risk pulse, and this is from the World Economic Forum over the last years, that ESG moved to the top of the agenda. So 3/4 out of the top 5 risks seen globally, and that includes financial risks, are environmental risks, so climate and water. So the attention and the feedback mechanisms increase, and that's why we're having those discussions in the meantime. EU case for sustainable finance, another driver I mentioned. So last year in April, the EU published the so-called 10 points action plan for sustainable finance. And behind it are political targets, actually mostly the environmental targets of the EU. So the EU is committed to a carbon neutral economy by 2050, and it has drastic carbon reduction targets by 2030. So versus 1990, 40% of greenhouse gases are expected to be reduced. Then also energy savings of roughly 32.5%, or a third versus 1990, or business as usual scenario, and a third of the energy mix supposed to be sourced from renewables. Now, to achieve those targets, the public finance is not sufficient, and the EU estimates the finance need for the energy targets we achieved of roughly 175 billion per year, and if you add water, it gets up to 270 billion. So that is a question, you know, how can you attract private investors into those themes? And we certainly have then another discussion, how do we manage to achieve future growth in the economy? And we just published an article as Allianz Global Investors on the tandem growth of GDP through sustainability innovation and what kind of value it can unlock for the European economy, but also globally. So to give you some figures, on the so-called 17 Sustainable Development Goals, 6 trillion of finance is needed. So the figure is, of course, much bigger than the 270 billion because it's a global figure. But the potential value to be unlocked is enormous. So there are estimates that this goes to the 26 trillions or so. I think in essence, what's important is if we want to sustain a level of prosperity that we have achieved and well-being today into the future, we have to innovate and transform the economy, which in itself then creates investment opportunities. So that's a bit of the bigger picture discussion here. I now move on to the next part, which is about investing. Of course, like as an investor, when you talk about ESG, you want to understand what do you get from it in terms of investment performance. So we as Allianz Global Investors are having a clear commitment that ESG is improve the investment performance, the investment outcomes, so that's why we mainstream it. But of course, you need to understand what sources you pull to improve performance. And this is a simplified chart, and we see basically 3 sources that add to ESG alpha. The one is understanding that ESG is an important driver of so-called intangible value of corporates that have increased their share of market capitalization tremendously over the last years, and I'll come back to that later. The second is ESG, as mentioned, aims to contribute to better risk management in assets and aims to avoid large portfolio drawdowns by really have a holistic picture at all risks, including ESG risks. And the third one is that ESG is typically pretty gray. So there were a few cases, if you look at it from an investment perspective on sectors, corporates, and so forth, where you say there's a clear yes or no interpretation about ESG risks and opportunities. So it takes fundamental research and an opportunity here to exploit the market efficiency. And all the 3, incorporating it in fundamental research, managing the risk through a risk-reward trade-off. It's not about avoiding risk. And the third one, making use of the market inefficiency of ESG, then gears towards ESG alpha. I will come to all these points. Now, explaining ESG, part of the intrinsic value of corporates. What we've seen in the S&P 500 is that when market capitalization of that index is explained, it's now over 4/5 in intangible assets. So if you take Silicon Valley companies like Alphabet and Facebook and so forth, it's up to 90% or even larger. When you look at ESG, often, let me start from the right-hand side, in intangible assets, if you have brand value as an asset, trust in products in the company translate into the brand value, so hampering the trust in a company for example, privacy issues on a social media network provider impairs the brand damage and also the corporate value. On the tangible assets, even though they have reduced, here as an example for the S&P, dramatically versus the last 40 years in terms of explanation of market capitalization of S&P, we still have risks. So on the ESG side, especially, we have a lot of talk about stranded assets for oil gas companies. So what's currently on the balance sheet in terms of oil, gas, wells and reserves, especially those that are not drilled yet and difficult to access in the Arctic, for example, with more costs. The question is, will that ever pay off, and is that asset value as high as it's in the balance sheet, or should it be depreciated? The same goes for physical climate risk. Unfortunately, and I'll show you in a second, we already have global warming. So we'll see more physical climate change, and the analysis, of course, into the assets of a utility or companies that are internationally operating in terms of real estate being flooded or impaired for other physical climate change risks is increasing. Last point, of course, also for an insurance company, quite important to understand where the future physical climate risks are in terms of insuring and making a profitable insurance business. So that's a bit of explaining the intrinsic value. But I want to spend a bit more time on ESG risk. Why is that so? Because in our research as Allianz Global Investors, and also supported by other research, we mostly see evidence that ESG risk is, or ESG as a factor, investment factor, is priced on the downside. So it's more a risk factor. It's less a factor that is priced to the upside. But ESG risk has become a bit of a buzzword. Mind you that it's also in the regulation. So for example, on the EU regulation, it will be mandatory going forward that all funds are ESG risk managed. So it's not a could do, but it's a should do, but we as an active asset manager do it because we're strongly convinced that it is paramount to deliver better risk-adjusted performance over a market cycle to deeply look into ESG risks. How do we frame ESG risk? Quite important also to be precise about that. We see macro ESG risk, so typically climate change is an example, and the GDP damage. You all may have read about the Stern reports, and I'll pull out a figure in a second, impairs GDP growth. Then there is sector ESG risk. We'll use, for example, the coal sector devaluation as an example. Then there is portfolio ESG risk. It's mostly the stress testing and drawdowns by ESG. I myself did some quant studies 10 years ago on pricing ESG tail risk for portfolios with a focus on carbon emissions right price with social risk and governance risk. I was laughed at back then. It was a bit too early ahead of the curve. It was very hard to find people to listen to you. Now it's the mainstream discussion, pricing of ESG risk with portfolio on the portfolio level and asset allocation level. And then idiosyncratic risk is corporate-specific ESG risk. So that's when you typically have a fundamental analysis of a corporate. You look into, of course, the typical financial fundamentals, as what we do, but also you want to understand how ESG factors may benefit or impair the future profitability and destiny of a company. As said, like if you open up daily news, you read examples over the place, also bring some example on a specific corporate. And then you have the regulatory ESG risk that goes all across the corporates, for example, carbon pricing. And it's not only an equity story. As said, my job is about integrating ESG in Allianz Global Investors across all of us, our assets. So it's as much about credit, government bonds, alternatives. It's not only an equity story. Now, coming through each column of ESG risk, I start with macro ESG risk. And here are some figures, inconvenient truths, as we called them previously. The IPCC, the International Panel on Climate Change, estimates a global warming by 2100. You may say, that's a long time ago, I don't care. But maybe you have children and they will care. That there is a 3 to 5 degree global warming. By the way, if it continues business as usual, so what they call the base case. We have already achieved a global warming, and that's measured by not a biased organization, but the NASA and also the ESA, they have satellites and they can measure pretty precisely. You can access that through web page that with nearly 0.9 degrees of global warming. So when we talk about Paris-aligned 1.5 and 2, and look at that from a risk budget, we've already eaten up nearly 50 or more than 50% of our risk budget. Because anything beyond 1.5 or 2 is really shifting, then driving weather extremes to an extent that it may impair also the GDP. And here's a forecast that says if climate change happens the way it's running with business as usual, we may see up to a quarter, and that's a conservative estimate, reduce global GDP. And there is some worst case scenario analysis where it says it kills 50% or more of GDP. So you have some macro interest to deal with climate change in particular. And the last one is, for example, good evidence that it's happening already. When you look at the claims from physical climate change over the last 2 years, they have risen beyond the 10-year average heavily. So here we have nearly $500 billion of damage for physical climate change. Sector ESG risk, just a quick one here. This is the coal sector, heavily underperforming. The World Equity Index, while that has performed over the last, since 2011 till August 2018, 142% increase. The coal sectors, and we chose 2 here, have lost like 60 to 80%, depends which one you're using. It just says that also, you know, it's happening here as an evidence that technologies that have comparative disadvantages, like coal has a technology disadvantages where it is PV as a switch cost, for example, or marginal cost, and have negative environmental effects, suffer. So there's some pricing evidence on the sector level. Now I mentioned on the portfolio tail risk, I said like first analysis I did 10 years ago, we are just about to launch a new study we did. I will not dwell down into detail. We constructed different types of portfolio, more exposed to ESG risk, less exposed to ESG risk. The big picture is, I said, like there's strong evidence that there is ESG risk in the tail end of portfolios. You got to manage the tail end. Whether you take maximum drawdown or 1% value at risk, it doesn't matter so much. And that this tail risk end of portfolios needs to be analyzed. And as I said, it's not about avoiding risk per se. It's like taking a risk like any other risk as an investor, as an active investor. It's about analyzing, understanding, and making risk-reward trade-offs. But quant analysis is important because it goes beyond anecdotal evidence, obviously, on tail risk. Now, anecdotal evidence comes mostly from idiosyncratic ESG risk. Now here, we have taken the famous PG&E Chapter 11 case, so a US-based utility that filed Chapter 11 after all the fires in California. So you can say also physical climate risk already affects the destiny of very exposed companies like utilities, but also mining potentially and others. So you've got to look into those sectors more deeply and those corporates to understand. And you see, like in the pricing, also, of course, here you see a good impact on the credit default swap spread, but also on the stock price. It reflects its material. It's not a hypothetical discussion. You find a lot of these cases, and the trick, of course, is to anticipate what's happening. So we did a study where I've not put the slide here on, for example, Turkish government bonds, where we found in 2016 a strong governance social risk signal and compared it to the credit default swap spread and said, like, here, the signal is strong, there's something wrong. Everybody reads about it, governance, social issues, but the credit default market for Turkish bonds seems to be complacent. And then, boom, a few months, a year later, the perfect storm emerged, and we all know where Turkish bonds are today. So it's not theory, it's real. Now, regulatory ESG risk is that like goes across all assets, especially on carbon emissions. Currently, about 20% of carbon emissions are taxed and globally, so that is expected to rise because we all know carbon emissions prices. We have the EU carbon emissions trading scheme. They rise, so the EU carbon emissions have risen lately quite heavily by more than 300% from February 2016 to February 2019. The true cost is questionable to estimate, but there are a lot of voices, and especially by corporates, by the way, who want carbon emissions rights prices to rise up to 50 or 60 euro. And all that pricing is quite important also to shift the transition, to make those investments to pay off and to be rewarded. So this is one of the points you really have to look into to better understand future prospects of industries, corporates, how much they are affected by rising carbon prices. Now, from risk to opportunity and impact, I've chosen the green bond example. So we offer a green bond. So I said, as much as it's about risk management, ESG, and understanding where corporates and sectors are on the transition to a sustainable business model, how much CapEx they invest into sustainability innovation, how much their cost of capital is affected by not managing ESG risks properly, by disclosing better on ESG and having a good dialogue with investors. Also here, the opportunity piece is important. And we translate, for example, money invested in a green bond fund has positive effects on renewable energy installed, capacity generation, but also carbon emissions avoided. So you can add to the investment product, not only that it's a safe product, investment grade, typically green bonds, but it has a concrete additional utility, and that's the innovation piece in ESG for anybody, benchmark provider, asset management, that there is something new, and that's, I think, why we are also having a lot of attention right now, not only to talk about risk reward and return and attractiveness of assets and funds and products, but also to have this additional USP in the story. Now, again, here, I think it's also important not to have a too digital world. I said, like, ESG is pretty gray when you look at it from a fundamental perspective. So if you take, for example, here, a Luxembourg-based steel company, that's a bit of an example how we do it as Allianz Global Investors. Of course, we take external ESG risk ratings, in this case from MSCI, but also from others. And what we say is just relying on external research is not enough. And I'll come back to that in a second. So we have a global dialogue on ESG risks. We have a global discussion on our digital platform. We document that. We may disagree. We may override external ratings and then come to a different conclusion, especially after engaging with corporates and finding out what the corporates do on the hotspots. So, for example, in this case, MSCI gave that steel company a high risk for environment. Steel company emits a lot of carbon emissions. So they said, like, what happens if the EU emissions rights price peaks to the P&L? P&L stress testing is important. We said, like, that's maybe a bit too simple. We talked to the corporate. We found two things. The corporate invests a lot in low carbon technology in steel production. That wasn't reflected in the MSCI rating. And the second was also, we made them more aware how we as investors look at them as a corporate, what's important for us in terms of assessing their climate transition risk. That dialogue revealed us to upgrade the risk to a better risk. And so what I say is a risk-reward trade-off. It's not black and white. And it may be an opportunity to buy into a corporate or a sector that even is perceived risky when you see an improvement delta. Now on the next level, so far I've talked a lot about ESG as an alpha source, how we practice it, at least as Allianz Global Investors, but also others in the industry, to make better risk trade-offs on ESG. So what's the next level? I've said, like, there's a strong momentum, but there's still a lot of parts that need to be done. So when you look, for example, at ESG ratings provided these days, this is one of my favorite analyses, and you take two different sets of ratings. So in this case, MSCI and Sustainalytics and you correlate them on the same investment universe. What's quite interesting right now, because the methodologies differ a lot, you get a very low correlation. So here 0.2. So what it means is by simply switching the ESG data provider, you get different portfolios if you use them as input without having done anything else. When you compare that with the credit ratings, you get a far higher correlation. So if you take S&P and Moody's, which partially may deviate, but largely here 0.8 correlation, agree on the opinion of underlying corporates here, S&P 500. So the ESG research data are good as a starting point, are important input, are improving. But when you look at them, they're mostly backwards looking. They rely on corporate disclosure that is limited, as we know, on ESG, that is largely not integrated with financial reporting. So all the major topics about having strong investment signals need to be better addressed, either through fundamental research. That's why an active manager like us takes them as a starting point, but mostly relies on our fundamental in-house discussions and risk-reward trade-offs. But also here, relying on external ratings may only simplify the whole picture. So what is another important development here is how to build stronger investment signals. And I mentioned, as one of the alpha opportunities is the market inefficiency in ESG, the fuzziness around ESG. That's typically a good thing about, market efficiency hypothesis. If there's inefficiency, you can create some alpha. Especially on ESG, as we learned, I showed you the slide, relevance of ESG in intrinsic value of corporates. It makes sense to look deeper into that. And of course, we have heard about the big buzzword of artificial intelligence, where I was told by many professors there is nothing like that. But here on the ESG side, you see quite interesting application grounds. So ESG asset typically looks into the past, but can also look into the present and future. What I'm interested in as an investor is the delta, the improving, the capex of a corporate, the change, the improvement on ESG issues. It's less like saying this is a bad company, this is a good company. Companies are like what they are. Then we have formal or informal disclosures. I mentioned like a limited disclosure right now, especially on ESG, with a lot of regulation kicking in, TCFD, for example, non-binding guidelines in Europe and the integration of the two. But also you need dialogue with corporates to really understand what the strategy of a corporate is. Corporate may not want to disclose everything in detail for good reasons. We need to understand and also talk and say as an investor, I think you should do this and that will be delivering you a more profitable, sustainable business. Of course, in ESG, there are a lot of metrics that are difficult to quantify, not to speak of limited time series. So that's also what needs to be dealt with. And what here, interestingly, needs to be explored, and we are also working on that as Allianz Global Investors, but there are also a lot of fintechs, for example, looking into that. Is how cognitive language recognition and all these techniques can amplify that fuzziness around ESG into a stronger investment signal. And ESG is not the only signal, so you always have to look into the fundamentals of a corporate and get a total picture. That's what makes it tricky, but the trickiness is that a lot in the market still simply apply external ratings without further reflecting on them. And that, in my view, can be challenged as an approach. The next stage, so to say, what are the pieces of the ESG puzzle that I think are important, need to be solved and needs to be worked on. So we got to move beyond ESG ratings to a certain degree that are heavily constrained by limited backward-looking disclosure. So change from a backward-looking to a forward-looking analysis of corporates and sectors. We have to think about, how IAI can help. So what I've seen in fintechs is the typical techniques of big data harvesting, so constant data harvesting of the web, cognitive language recognition. So you check data published on different news streams, either by the corporate, either by news providers, financial news providers, or social media. You check for consistency of those signals, and you try to find deviations, and also how that links to the pricing of the stock or the bond, and then try to distill some meaningful investment signal. From everything I've seen, there are promising technologies, but I've nothing seen where I can say that, yeah, you can rely on that. And likely in the future, it's also our view, it's always going to be a man-machine model. So it cannot be automized by itself, or a self-autonomous ESG web alpha engine. Yeah. The next point is, we're in investing, so performance attribution of ESG and measurement is key. We're also working on that as Allianz Global Investors. It's a tricky topic, but the language in investing is about performance attribution, performance analysis, if you do relative benchmark products. So also all the story about the value add of ESG I dwelled on, it needs to be measured with the common tools that are applied in the investment industry. One of them is performance attribution analysis. And here, also quite interesting, here we see in our own research that, for example, some of the outperformance that some portfolios claim to have by ESG integration can be challenged in the sense that it's not the ESG signal, but it's a hidden factor tilt to quality or growth or whatever. And then this is what drives the performance relative to the parent benchmark or reference portfolio, and less so much the actual ESG investment signal going to the portfolio. And I think that may sound a bit shocking to you, but I think what it says, and I'm also here, STOXX, I know they manage everything with risk modeling. That's what you got to do. You got to analyze all the factors in a portfolio after the ESG integration and understand what kind of factor exposure you may have created inadvertently. Now that was on the alpha side a bit more. And now on the risk side, also adding to the alpha, avoiding large drawdowns is key. A drawdown kills the performance. You had Professor Merton last year at this conference and focusing on that part. A lot of discussion, as said, like here also by the FCI, TCFD, but also all the regulators, the Network for Greening the Financial System, all the central banks, is the systemic carbon risk. So Paris alignment of portfolios, and by the way, you have to disclose Paris alignment of all benchmarks, at least in the EU, in about 2.5, 3 years, is key. How to do that, carbon stress testing. It takes reliable quantitative models as well, and this is something where I said, like I did it myself 10 years ago with quant research. We were quite ahead of the curve, but still I think this is not 100% solved. You do some stress testing, sensitivity analysis, but you build assumption over assumption, so you have to accept when you go down that route, you adding assumptions. The last point is about ESG, is about long-term investing, so it's not about short-term investing, but it's great to see as a portfolio manager you need also hedging tools. The Eurex futures were mentioned as an example with STOXX underlying. I think that's a great innovation from what I've heard. It's picked up nicely in the market. Derivatives are important for cost-effective portfolio risk exposure management, also on the ESG side. I would expect more innovation to kick in and come, and what I hear and see is coming. But those are very important additions, and it's not only about ESG index futures, but it's also as much about hedging carbon risk, hedging physical climate change risk to a certain degree is an interesting topic, because here is also some concrete demand. So that adds to the whole puzzle, all those parts. I think when they are solved and there's a bit of work to do, then in my view, ESG will unleash the very full potential it has for investment performance. Thanks for your attention.
So I think that we're going to, thank you. I think we're going to take some questions we have.
Thank you very much for a very interesting presentation. Lots of great data in there. I was quite interested in your point about ESG extended DCF model. Obviously, it's quite easy to put quantifiable data into a DCF model, but how about less quantifiable data, so data that might be a bit more qualitative in nature? Thank you.
So DCF models typically, either you can add ESG as part of the cost of capital with an assumption, or you also model in the free cash flow, either as whatever demand decrease, profitability decrease, or the other way around, increase and cash flow increase through sustainability innovation, share of green products, and so forth. So again, here we're talking about models. And if I understand your question, it goes, how can you add qualitative information? I think to be quite fair, so us as an active asset manager, of course, we have DCF models, but we, in the end, have a judgmental view on ESG. Yeah? So qualitative aspects need to be analyzed, and given what I've mentioned, that typically the picture is fuzzy. So what looks like, there's nothing like a clear case with ESG. I said, like, look at the steel company example. I said, like, simplified, you would penalize it, high carbon emitter, but we know we all need steel. Concrete, cement is the same story. For windmills, you need cement founding, so that demand doesn't go away. It's more understanding how the transition of those companies is managed. Qualitative would be, is the management having a strategy? Is it having a risk management of the ESG? Is it actively addressing the ESG issues in their sector? That's the judgmental view.
Okay, maybe, if you can hear me, maybe I'm going to offer you a question from the app. So the question is, in regards EU regulation, which I think ties well with our next panel, do you expect benchmark indices to change? Are we trading in the future the low carbon version of STOXX 50?
So precisely, I'm talking now about the EU Sustainable Finance Benchmark Regulation. It is, technically speaking, an amendment of the benchmark regulation on two parts. What will change is, and I think that's the biggest impact, is the so-called ESG disclosure requirements that will over time concern all benchmarks. I'm not just talking about ESG benchmark, all benchmarks. So what it takes is something about how does ESG play a part in the benchmark statement, and also in the methodology. Yeah? So I think this disclosure has a huge pull effect. And how does it have a huge pull effect? Because there's also the disclosure regulation on financial products that, for example, concern us as an asset manager, that asks explicitly to refer to the benchmark, and then hence, bingo, you also need to refer to the ESG in the benchmark. The second question here on climate benchmarks, though the EU is regulating two types of climate benchmarks, the so-called transition benchmark, and then the so-called Paris-aligned benchmark. So both deal with benchmarks that aim to reduce carbon versus parent benchmark, / want to have a benchmark that is 2-degree aligned or Paris-aligned. Minimum requirements for running them. Does this change the way climate benchmarks are provided and done? A bit early to say, but yes, by defining minimum requirements, the goal is to harmonize climate benchmarks. That's the EU goal, so you can compare benchmarks, and that's also why Paris alignment disclosure is important, but also the methodology wants to avoid greenwashing of climate benchmarks. That's the other outspoken target. True to label, so to say, that's what the goals are, and I think it will... The regulation will have quite an impact.
Thank you, and I'm going to go on with the questions on the app. That's an interesting one. What's Allianz's appetite for ESG investments at the venture level is?
So speaking for Allianz Global Investors, we have alternatives. We have less venture capital, I have to say. We have more brownfield alternatives. Even though a lot of sustainability innovation takes place in the venture capital area. So now speaking from my parent company, Allianz Insurance Company, again here, I think it's important that the risk characteristics of an asset need to match the risk appetite. So the venture capital is looked at, but it needs to be understood what kind of risk you're buying. Yeah. On the other hand, of course, like when you go into brownfield and renewable energy, we all know the big issue is, for example, that too much money is chasing too little assets. So you get compressed yields. So it needs to be monitored, and let's see what's happening.
A very last one, I think, for the reason of timing, but you have the microphone, so go ahead.
Okay, thank you. I was wondering if you guys at Allianz did a deeper analysis on the underperformance of the coal sector to try to understand what in fact led to the underperformance, if it was big pools of capital, big institutional investors that were prevented from investing in coal, or if the retail investors or shift in ETFs or anything like that, it would be great.
So mostly it's a cost disadvantage of the technology. You still need, don't get me wrong, I mean, again here, having a broad brush picture, I think is wrong, because in some markets, in emerging markets, you need coal-powered utilities to supply the local economy with a stable stream of electricity. But technology-wise, photovoltaic has a comparative cost advantage. So the other part of the story is that coal, thermal coal, is over-proportionally emitting carbon emissions. So anything that regulates those carbon emissions is also not adding exactly to the performance of those assets.